The timeless investment strategy. Everything you need to start making money in the stock market today. Investpreneurs, Book 1. Written by Bill Grand, narrated by Russell Newton. The ultimate goal of investing your money is to earn back more than your initial investment. This is what makes it different from simply saving your money. Investing money doesn't just wait for you, it grows. The longer it sits in savings, the bigger it grows, which is why time is the key ingredient to a profitable investment strategy. But why does invested money grow? How can it be that money simply sitting in an account can earn you profit? The secret is called compound interest. Robbins Research International, Inc., 2020. The number one reason that investors fail to make big returns on their investment is because they don't fully understand this simple concept. Compound interest is the reason that the amount you invest doesn't matter. Too many people make the mistake of thinking that investing is something that you do after you already have a sizable savings. But the ultimate goal of investing is to grow your savings. Even the smallest investment can swell into hundreds of thousands of dollars given enough time. A small investment that spends years accruing interest will always result in a higher profit than a large investment that doesn't have as much time to grow. It's accrued interest that makes investments profitable, not the investment itself. Robbins Research International, Inc., 2020. Think of your investment like a snowball rolling down a hill. The size of the snowball when it reaches the bottom has nothing to do with how big a ball you started with. It's about how high the hill is. Sure, if you build a big snowball and roll it down the hill, it will be bigger at the bottom. But your hill is short, it's not going to grow very much. On the flip side, a tiny snowball rolling down a very big hill is going to pick up a great deal of snow. At the base of the big hill, you'll end up with quite a big snowball indeed. In this example, the snowball is your investment, the hill is the amount of time you have, and the snow is the compound interest. Perhaps another way to think about it is planting a tree. The size of the seed has nothing to do with how big or fast your tree grows. Even the tiniest seed can grow into a massive tree if it gets the right amount of sun, water, and is planted in healthy soil. To tap into the power of compound interest, you have to stop thinking about your investments in terms of money and start thinking about them in terms of time. No matter how old you are, the best time to start investing was 10 years ago. The second best time to start investing is right now. So, what exactly is compound interest? Albert Einstein called it the most important invention in all of human history, but that hardly helps us to understand how it works in real financial terms. If you don't understand compound interest now, don't worry. Many people have never even heard of it, and that's why so few people take advantage of it. Robbins Research International, Inc., 2020. But you're no longer going to be one of those people. We'll begin with the dictionary definition of compound interest, which reads, a method used to calculate interest paid on both the principal and on accrued interest. To put this more simply, compound interest is interest paid on interest. Rather than taking the initial interest on your investment as a payout, you reinvest it. When the next period comes around, the interest that you've earned is not only on the principal sum, but on any interest that was previously accrued on that sum. The actual amount of money you'll earn in compound interest will depend on how much money you've invested, the percentage of interest paid on that amount, and the number of times per year that interest is paid out. Depending on the account, interest could be paid out yearly, half-yearly, quarterly, monthly, weekly, daily, or even continuously. The rate at which interest is paid on your account is called the compounding frequency. The more frequently interest is compounded on your investment, the more money you'll make. Robbins Research International, Inc., 2020. To demonstrate how this works, imagine that you open an investment account and invest $100. If the annual compound interest rate is 3%, then by the end of the first year, that $100 will have grown to $103. But the following year, you won't just earn interest on that initial $100. You'll be earning interest on $103, which means that your account will earn $3.09 in interest instead of $3. So the year after that, you'll be earning interest on $106.09, and so on and so forth. After 20 years at this rate, your initial $100 will have grown to $180.61. Simple interest, on the other hand, is the interest that's only paid on the principal sum. So in the previous example, if you had a simple interest rate of 3% rather than a compound interest rate, you would only earn $3 in interest every year, no matter how much money you had accrued in interest. After 20 years on a simple interest rate, your account would only have grown to $160. With compound interest, the exact same amount of money at the exact same interest rate would have made you $20 more. And while that may not seem like much, if you have 30, 40, or 50 years to let your money sit and accrue interest, compound interest could potentially make you $40, $60, or even $80 more than simple interest. Another important concept is the difference between APR and APY. APR, or annual percentage rate, is the annual rate of interest that doesn't factor in compounding. APY, or annual percentage yield, on the other hand, is the annual percentage rate that reflects the entire amount of interest paid on the account, including interest that's been compounded. Both of these numbers reflect the amount of interest paid on a 365-day period. Robbins Research International, Inc., 2020. When considering an account in which to invest, you can use a simple formula to calculate how much money you'll earn annually off the initial investment. The compound interest formula is A equals P, quantity 1 plus R over N to the power of NT. This might look complicated, but it's actually quite straightforward. The P in the formula stands for the principal amount, or the initial sum of money that you've invested into the account. R is the interest rate, and should be entered into the formula as a decimal amount. So if the interest rate is 3%, you should enter it into the formula as 0.03. N is the number of times interest is compounded in a single year, so if the interest is compounded yearly, N would be entered into the formula as 1. The T in NT is the amount of time that the money is invested for, so if you plan to let your investment sit for 20 years and interest is compounded annually, then NT would be entered into the formula as 1 times 20. Remember that NT is an exponent, so if the interest is compounded once a year for 20 years, you'll take the number inside the first set of parentheses and raise it to the 20th power and multiply that number by P. Robbins Research International, Inc., 2020. Let's look at an example to get a good idea of how the formula works. Imagine that you want to invest $5,000 into an account with an interest rate of 5% that is compounded monthly. Your formula would look like this. A equals 5,000 times 1 plus 0.05 divided by 12 to the power of 12 times 10. First, calculate 0.05 divided by 12, then add 1. Raise that number to the 120th power, since NT in this equation is 12 times 10, or 120. Multiply that number by 5,000. If you do the math, you'll see that the final results are $8,235.05. So, in 10 years' time, your initial investment of $5,000 will have grown to $8,235.05. But if you contribute an additional $5,000 to your account every 10 years, then, after 20 years, your account will have grown to $21,798.25. Let's look at a few more examples to really understand how compound interest can be used to make you as much money as possible on your investments. Example 1. You have $10,000 to invest for a period of 5 years. The account you choose has a 3% interest rate that is compounded monthly. At the end of 5 years, your initial investment will have grown to $11,616.17. If you contribute an additional $10,000 to your account every 5 years, then after 10 years, your account will have grown to $25,109.71. Robbins Research International, Inc., 2020. Example 2. You have $10,000 to invest for a period of 2 years. The account you choose has a 2% interest rate that is compounded quarterly. At the end of 2 years, your initial investment has grown to $10,404.07. If you contribute an additional $10,000 to your account every 2 years, then after 4 years, your account will have grown to $21,234.66. Robbins Research International, Inc., 2020. Example 3. You have $1,000 to invest for 1 year. The account you choose has a 5% interest rate that is compounded twice a year. At the end of the year, your initial investment has grown to $1,050.63. If you contribute an additional $1,000 to your account every year, then, after 2 years, your account will have grown to $2,154.44. As you can see, compound interest means that the money you invest grows exponentially every time interest on the account is compounded. So if you stick to a regular investment schedule, then every time you raise the principal on the account, you start earning back double and triple the amount that you're investing. This is why time is on your side when it comes to compound interest. The longer you invest, the higher the principal in your account becomes. Soon, you don't have to invest anything to begin earning back hundreds of times in interest what you initially invested. To understand this concept better, let's take a look at two best friends. Their names are Ellen and Chandra. When these two women are 20 years old, Chandra decides to open an investment account. Every year, over a period of 20 years, she invests $4,000 at a growth rate of 10% per year. At age 40, she stops contributing her yearly $4,000, but lets her account continue to accrue interest every year until she turns 65 years old. When she finally decides to withdraw, she will have almost $3 million in her investment account. Now, let's take a look at Ellen. She doesn't decide to open an investment account until age 40. Her plan is identical to Chandra's. Her plan is to invest $4,000 every year until she turns 65 years old. She will actually be contributing more money to her account, saving over a period of 25 years. That's 5 more years, or $20,000 more than Chandra. Her growth rate is also 10% annually, the same as Chandra's. But at age 65, when she goes to withdraw, she will barely have $500,000 in her account. That's 600% less profit than Chandra. Robbins Research International, Inc., 2020. Chandra actually contributed less money and saved for less time, but because she had an additional 25 years to let her savings grow, she made substantially more money than her friend who started saving later in life. Compound interest means gathering interest on top of interest, so the longer you can let your savings accrue, the more money you stand to make, no matter how small your regular investments are. Robbins Research International, Inc., 2020. No matter how old or young you are, the time to start investing is now. Don't wait for that big bonus or raise to open an investment account. You may not think you have enough money to spare toward a regular investment schedule, but people of all incomes have the ability to invest. If you're still skeptical, meet William. He's 20 years old. He still has 2 more years of college left to go, but he's already accrued $60,000 worth of student debt. He's working part-time at a minimum wage job to pay his rent while he's in school. He has no savings, no assets, and until he starts paying back his student loans, no credit. But he's going to the bank to open an investment account. His investment schedule? $1 a week. That's right, $1 a week. That's $4 a month. At an APY of 0.25%, his savings will grow to $527 after 10 years. It will grow to $1,067 after 20. After 20 years, he can choose to increase his contributions or he can stop and let that $1,067 continue to accrue interest for another 25 years until he retires. If he increases his weekly contribution to just $10 at the same interest rate, he will have $5,266.60 in savings after 10 years, and $10,665 after 20 years, which he can then let sit and accrue interest for an additional 25 years before he retires. Compound interest basically supercharges your savings account. The more you have in savings, the more interest you accrue. The more interest you accrue, the more interest you accrue on that interest. Though it starts slow, especially if you don't have much to contribute in the beginning, it doesn't take long for your profits to start doubling and tripling every year. Even a basic savings account at your personal bank can be set up with compound interest. This investment account is by far the least risky. However, most U.S. accounts have extremely low APYs. Like William, the interest rate on a basic savings account is most likely to be well under 1%. This is why defensive investors tend to put their money into investment accounts that will earn them a bit more money. Account types such as Roth IRA, SEP IRA, 401k, or Coverdell ESA are all very low-risk, secure places to invest your money where it's fairly easy to find APYs at 1 or 2%, if not more. Most of these accounts are retirement accounts and are set up with the understanding that you're not going to be withdrawing your money until you reach retirement age. Coverdell ESA accounts are education accounts that parents can open when their children are born and regularly contribute to until their child is ready to go to college, at which point they can withdraw their savings and all of the compound interest they've accrued over the years. Robbins Research International, Inc., 2020. So, even if you only have $1 a week or $5 a month to spare, now is the time to start investing your money. Slowly but surely, that $5 will start to grow into something much bigger. And if you get a better job or a raise, maybe you can turn that $5 a month into $5 a week, which will exponentially increase your earnings thanks to the compound interest that you accrue with each investment. Robbins Research International, Inc., 2020. The Rule of 72. Don't overcomplicate investing. Keep it simple and timeless. A. Nowakowski. The beauty of compound interest is that it's essentially free money. It's money that you earn without having to do a thing. But, as you've already experienced, determining how much money you stand to make based on principal, regular contributions, and interest rate can require a great deal of math. If your head is spinning from all the numbers, letters, and formulas, don't worry. The website moneychimp.com has a handy compound interest calculator that helps investors to determine how much they stand to earn in compound interest from current or potential accounts. The calculator will ask you for the amount of the current principal, as well as the amount of future additions, which will save you from manually calculating the compound interest formula for every single additional investment. The compound interest calculator will also ask you how many years you plan to make these additional investments, your current interest rate, and how many times interest is compounded on the account annually. You can use the calculator to determine both how much money you stand to make while you're saving and find out how much the account will grow once you've invested your planned amount. MoneyChimp.com 2020. Let's look at a few examples. Imagine that you're considering opening an investment account. The APY for the account is 20%. You'd like to make an annual investment of $1,000 into the account over the course of the next 20 years, bringing your overall investment to $20,000. To start out, your principal amount is only $1,000. The annual addition to the account will also be $1,000, as that's the total amount of your annual investments. Years to grow will be 20, as that's how many years you plan to invest $1,000 per year into the account. The APY is 20%, so you can enter that into the calculator as a 20% interest rate compounded one time annually. Choose to make your additions at the start rather than the end of each compounding period. At this rate, your account will swell to a staggering $262,363.20 at the end of 20 years. And if you've opened this account while you're still in your 20s, you can let that $262,363.20 sit and accrue interest for an additional 20 years before you retire. 20%, however, is a remarkably high interest rate, one that you're probably only going to find on a very risky stock market purchase. Let's look at another example that's slightly more realistic. Imagine that you have $1,500 to invest every 6 years for a total of 24 years. The account that you've chosen has an interest rate of 4.3%, which is compounded quarterly. To use the compound interest calculator, begin by entering $1,500 into the principal amount as you've just opened the account. You don't plan to invest another $1,500 for another 6 years, so divide $1,500 divided by 6 to determine the annual addition amount. If you do the math, you'll find that you only have to invest $250 per year in order to invest $1,500 into your account every 6 years. In the compound interest calculator, enter $250 into the annual addition slot. Enter 24 under years to grow. Enter 4.3% into the interest rate slot, and enter 4 into the slot for how many times interest is compounded annually. Choose to make additions at the start. You'll see that if you invest just $250 into your account over a period of 24 years, your account will swell to $14,713.13. Not a bad savings. But if you opened this account while you were still in your 20s, you now have another 20 years to let that $14,713.13 sit in your account and continue to accrue interest until you retire. To find out how much money you'll have when you're finally ready to withdraw, go back to the compound interest calculator. This time, enter $14,713.13 as the principal amount. Enter 0 for the annual additions amount, as you've already invested what you wanted to invest. Leave the rest of the selected fields the same, 4.3% interest, compounded 4 times annually at the start. Choose 20 years for the years to grow slot. You'll see that if you let your savings continue to accrue interest for the next 20 years, you'll have $34,610.28 in your account when it comes time for you to retire. While MoneyChimp.com's and other compound interest calculators greatly simplify the math involved in understanding how much you have to make from a potential investment, when choosing where to invest their money, many investors simply use the Rule of 72 to determine where and how to make the most money possible on their investments. Elkins, 2020. The Rule of 72 focuses on one specific component of the compound interest formula, and that's the interest rate itself. As you may have intuited, the higher your interest rate, the faster your investment will begin to make you money, while a lower interest rate will only make you money if you have a long time to let your money sit and accrue. Elkins, 2020. The Rule of 72 is as follows. 72 divided by interest rate equals years to double. If you plug your interest rate into this formula, it will tell you how many years it will take at your current interest rate for the money you've invested to double. This rule stands no matter how much money you initially invest. So if you're planning to invest $10,000, the Rule of 72 will tell you how long you'll have to wait at your current interest rate to earn $20,000. This rule is based on a 1% interest rate. So if you open an account with an APY of 1%, it will take 72 years for you to double your money. An APY of 3%, on the other hand, will only take 24 years to double, as 72 divided by 3 equals 24. An APY of 6% will only take 12 years to double, etc. When using the Rule of 72, remember that the interest rate that you're entering into the formula is the amount of interest you can expect to accrue in an entire year, or 365-day period. So if your account accrues interest twice a year or quarterly at a rate of 1%, then 1% isn't necessarily the amount of interest you can expect to accrue over the course of an entire year. This is why the more frequently your account compounds interest, the more money you stand to make. The Rule of 72 also helps to make it clear why a standard U.S. savings account is probably not going to cut it for the average investor. The average APY of a U.S. savings account today is 0.09%. According to the Rule of 72, it will take 800 years for your invested money to double at that rate. You'll still be making money, but not nearly as much as you could be making if you chose to invest that money elsewhere. Those with a great deal of money ready to invest often choose to invest in a high-yield savings account or a certificate of deposit, both of which typically offer interest rates around 2.49%, significantly higher than the average APY of a standard savings account. However, these accounts rarely prove profitable for those who don't have a large sum of money to invest initially or who don't have the funds to make large, regular investments over the course of several years. If you invest your money in the stock market, on the other hand, whether it's through an employer-sponsored 401k account, a traditional Roth IRA, or an individual brokerage account, you're almost guaranteed to make much bigger returns, no matter how small your investments are. The average annualized total return over the past 90 years for S&P 500 accounts is 9.8%. And if you adjust that number for inflation, the return percentage still hovers between 7 to 8%. Plug 7% into the rule of 72, and you'll see that it would take just over 10 years for your money to double. Elkins, 2020. To go back to our previous example, let's imagine that you choose to invest your money in the stock market rather than a standard savings account. Imagine that you choose to invest in an S&P 500 account, and your average growth rate every year is 7%. Using the rule of 72, you know that it will take a little over 10 years for your money to double at this rate. So, imagine that you make an initial investment of $1,500 with the plan to invest an additional $250 per year for the next 24 years. At 7% interest compounded annually, your account will grow to $23,170.81 after 24 years. Elkins, 2020. Another investing exercise is to plug the interest rates of your credit cards, car loans, mortgage, or student loans into the rule of 72 to see just how much money your outstanding debt is earning your creditors. Remember that the average annual interest rate for a standard U.S. savings account is only 0.09%, but the average annual interest rate for a credit card in the United States is 17.3%. At that rate, it will only take 4.16 years for the bank to earn back double what you initially charged on the card. And with a credit card or any other kind of loan, that extra money is coming out of your pocket. The reason that a low interest rate on a loan is the same reason that a high interest rate on an investment account is desirable: time. Applying the rule of 72 to future financial decisions can save you quite a bit of money, whether you're looking to take out a loan or invest your money. The rule of 72 can help you determine what a reasonable interest rate is and prevent you from falling prey to financial gimmicks from potential creditors or investing your money in accounts that ultimately aren't going to earn you that much money. Berkshire Hathaway and compound interest. Wall Street in New York City is the home to the New York Stock Exchange, NYSE. P. Weissenberger. Warren Buffett is undoubtedly one of the globe's most successful investors. In fact, a total net worth of $88.9 billion places him at the fourth wealthiest person on the planet. While CEO of the investment bank Berkshire Hathaway, he made his investors an unprecedented 2 million% return on their money over the course of his 52-year career. To translate that into real numbers, if you invested $10,000 into Berkshire Hathaway in 1965, your investment would now be worth $88 million. McKay, 2020. Undoubtedly, 1965 was a long time ago, but growing an investment by that much is almost unheard of. Warren Buffett's secret, as he himself has said many times, is playing the long game. He never expects to make himself or his investors money overnight. He understands that while compound interest is powerful, it's a lot more powerful over a long period of time. McKay, 2020. Compound interest is a snowball effect. The more money you have in your account, the more money you make. It's a deceptively simple idea. So simple that it's often overlooked or never considered at all by the average investor. In the words of Albert Einstein, compound interest is what makes the world go round. He who understands it earns it. He who doesn't pays it. Buffett is the star example of playing the long game because he started investing much earlier than most people. According to him, the book that changed his life was called 100 Ways to Make $1,000, a title that he found in the public library in his hometown of Omaha, Nebraska at age 7. Inspired by this book, he started his first business selling chewing gum, Coca-Cola bottles, and magazines door-to-door in his neighborhood. In middle school, he got a job working in his grandfather's grocery store. Using the money he earned at the grocery store, he bought his first stock at the tender age of 11. Specifically, he purchased 3 shares of City Service stock for himself and 3 for his sister, Doris Buffett. He was inspired to do so after a visit to the New York Stock Exchange with his family the year before. In high school, he invested the money he earned delivering newspapers into a business owned by his father. He earned his spending money selling golf balls and stamps, as well as detailing cars. As a sophomore in high school, he got into business with a friend, purchasing used pinball machines and then selling them to local businesses. When he graduated from Woodrow Wilson High School in Washington, D.C. in the year 1947, the tagline under his senior yearbook picture reads, "Likes math, a future stockbroker." That same year, between the stocks he had purchased when he was 11 and the money he had invested in his father's business, he had already managed to accumulate a savings of $9,800, roughly $105,000 in today's money. And because his money had been accruing interest for so long, he's managed to earn back 99% of his wealth since his 50th birthday. The interest that he's making on his investments is earning him hundreds of thousands of dollars every day, but it's because he started investing so early in his life. McKay, 2020. Buffett began his career as an investor in 1954, working under Benjamin Graham, the investor who invented the Mr. Market analogy for understanding stock market psychology. According to him, Graham was an extremely tough person to work for, demanding that all the company's stocks provide a wide margin of safety in addition to a high rate of annual return. Buffett's starting salary at Graham's company was $12,000 a year, about $114,000 today. After just 2 years, Graham closed up his partnership, but during that time, Buffett had been investing his money. In 1956, he had accrued a personal savings of $174,000, worth about $1.64 million today. He used a portion of this money to start his own hedge fund-like investment business called Buffett Partners Limited. He ran Buffett Partners Limited for 14 years. By 1962, Buffett's partnerships were collectively worth more than $7 million, of which more than $1 million belonged to Buffett himself. Eventually, he merged Buffett Partners Limited with a few other partnerships to form Berkshire Hathaway, the company where he would remain CEO for the next 52 years. McKay, 2020. It was during his time at the head of Berkshire Hathaway that he began teaching others how to invest their money in smart and secure ways. During this time, his investments were continuing to accrue interest, making him hundreds of thousands of dollars every year. But in order to let his money continue to grow, he let his investments sit and lived solely off his annual salary of $50,000 a year. By the year 1990, Buffett would be worth over $1 billion. In 2008, Buffett became the richest man in the world, overtaking Bill Gates for the top spot. While Gates managed to reclaim his crown in 2009, the power of Buffett's investments is not to be underestimated. In August 2014, a single Berkshire Hathaway share was valued at $200,000, and the price hasn't fallen far since. Over the years, he's become an incredibly popular and respected investment coach, partly because of his success, but partly because of the unique way he uses stories to illustrate abstract investment concepts. McKay, 2020. One such story refers to Queen Isabella's choice to fund Christopher Columbus' voyage to the New World. This kind of investment, he jokingly states, was quite risky indeed, more of a speculative venture than a sound investment. Had she chosen to deposit the $30,000 worth of today's money that she used to fund Columbus's expedition into an investment account instead, at an annual interest rate of 4%, the nation of Spain would be worth over $7 trillion from that account alone. Such is the power of compound interest. Miller, 2016. Another historical example Buffett commonly uses is the story of King Francis, who chose to commission the painting of the Mona Lisa in 1516. In today's money, the king paid Leonardo da Vinci about $20,000 for the painting. Had he chosen to invest that money at an annual interest rate of 6%, the nation of Italy would be worth more than $1 quadrillion from that account alone. Buffett regularly used both of these examples to discourage the idea that speculative investments, including high-risk business ventures, art, and property investments, can earn investors more money than traditional stock market purchases or retirement accounts. Miller, 2016. It's not a sexy answer to the question of earning money. Smart investing is slow work, there's no doubt about it, but the trick behind compound interest is that while it works at a slow pace, it doesn't necessarily work at a steady one. In the beginning, your money will grow slowly, but because you don't have as much principal in your account. But as the principal sum in your account grows, the more interest you make, and the more interest you make, the more interest you make on that interest. Before you know it, it's taking just a few years to double your initial investment amount, when it took you 10 or even 20 years to double it the first time. Miller, 2016. Investing your money doesn't just help you to save, it helps you to earn. Invested money works for you while it's sitting in its account accruing interest. Think of it like an athlete training and perfecting his technique. It might take him 28 years of training to finally win a gold medal in the Olympics, but every year that he competes, he's compounding the work that he put in last year and the year before and the year before. His strength and skill don't increase at a steady rate. His experience increases his strength and skill exponentially every time he competes. To look at yet another of Buffett's common financial anecdotes, let's go back to the year 1626. That is the year that the Manhattan indigenous nation sold their island home to a Dutch explorer named Peter Minuit for the price of $24. In 1965, the first time Buffett told this story, he estimated the land value of the island at that time to be around $12.5 billion. This, he calculated, worked out to be an annual gain of 6.12%. While this is hardly a bad interest rate, he calculates that had what he calls the tribal mutual fund managed to earn back 6.5% per year, their initial $24 would now be worth $42 billion. And had they managed to earn back 7%, that value makes a huge leap, up to $205 billion. This story doesn't just demonstrate the power of compound interest, but it demonstrates just how much money even a 0.4% increase in annual terms can make the investor. Half a percentage point won't matter much in the short term, but over time, it can quickly grow to be worth hundreds of thousands of dollars every year. As always, the key ingredients are time and patience. The longer you have to wait, the more money every single percentage point will make you year after year. Miller, 2016. This has been The Timeless Investment Strategy. Everything you need to start making money in the stock market today. Investpreneurs, Book 1. Written by Bill Grand. Narrated by Russell Newton. Copyright 2020 by Investpreneurs. Production copyright by Investpreneurs.